Your account number is a unique identifier, and it will appear on your checks. It will appear on your deposit slips, the printed ones. It will appear on paper and electronic statements. If you are doing anything at the bank at all, it is based on your account number, and that's because that number can be unique, but your name is not necessarily. For example, if your name was John Smith, there's probably several thousand John Smiths in this state or in the country. So everything's done by account number. Your bank statement is a monthly statement, and depending on the bank, they'll either do a 30-day period or a calendar month. Most banks do a calendar month, so the 1st to the 28th or 30th or the 31st. And so, or the 15th to the 14th, things like that, they usually do. And this can come either as paper in the mail, or if you choose to have it just electronically. For example, my bank statements, I don't receive them by email. I don't receive them in the mail. I actually have to go online, log into my bank, and pull it up. But it's there for me to look at when I want it. And the bank statement lists every transaction that occurred during the statement period. So if it's the 1st through the 30th, it starts on the 1st. It lists your starting balance, which is the amount of money you had in your account at the opening of business on the 1st. Then it lists every single transaction that occurred between that and the 30th. So every deposit, every withdrawal, every fee, any interest paid, transfers between accounts, any kind of transaction that's happened. And then it ends with listing the ending balance, which is the balance at the close of business on the last day of the billing cycle. Or the, not billing cycle, the statement cycle. So starting balance is in the morning on the 1st day. And ending balance is in the evening or late at night on the last day. Now, the balance, if you look at your bank statement and it says like on the 1st of the month you had $435.68, and then you look in your check register and say, that's not what my thing says I had on the 1st of the month. Your balance and your bank's balance, because of delays in transactions, will not match day per day. And including transactions, if you look on your bank statement and it says on, say May 10th, you spent $5 at Target, and you say, well, I wasn't at Target on May 10th, I was at Target on May 7th. Maybe it took those 3 days before it posted and showed up on your account. So your dates won't match necessarily, and your daily balances won't match. And that's why what we're doing now in this chapter is really important. It's called Reconciling a Bank Statement, and we're going to make sure that our information and the bank's information aligns to make sure there's no mistakes. Because you don't want to think you have more money than you do because you made a mistake, and you certainly don't want the bank to think you have less money than you do because they made a mistake. So you always want to check. The other thing that you need to know, this will not be on the statement. Outstanding deposits. These are the deposits that you have made that did not get printed on your bank statement. So for example, you know how they say deposits made after 2 p.m. will not show up until the next business day, kind of thing? Well, if I made a deposit on the 30th at 2:15, and then they print my statement that afternoon, that deposit's not going to be on the statement, even though I made it, because it doesn't post until the next day. So that would be an outstanding deposit. Outstanding meaning it's out there in the world, not on my statement. And then we have outstanding checks, which is kind of the same idea. These are checks or other transactions. So these can be debit or anything like that, electronic funds payment, bill pay, things like that. they don't show up on the statement yet. So for example, you know, it may take a couple, you write a check and you send it in the mail. So let's say I write a check today and I put it in the mail today, and it could take 3 to 5 days to arrive at its location. And then they have to process it. That might take a day, and then they'll put it in their bank account, and then it might take another 2 or 3 days from the time they deposit it until the money comes out of my account. So I write a check today, it could be 10 days before it shows up on my bank account. And if my statement gets printed between that time, that check I wrote is not going to show up yet. And so that would be an outstanding check. It'll come on the next statement, yeah. And then balancing a checkbook is also known as reconciling. Okay. And when you balance a checkbook, this is when you take your check register and you take the bank statement. So you're going to compare your records with their records. And then you're going to do some math because, like I said, their dates and your dates, so their transactions and your transactions, and when things fall into the bank won't necessarily match. So you're going to compare your records with the bank statement and calculate to ensure that you have the correct balance. And there's 2 reasons to do this, 2 major reasons. The first is if you made a mistake and you forgot to put in a transaction, forgot about a monthly fee, forgot any kind of ATM fee or anything like that, this will help you to catch that so that you can put it into your check register and make sure you have the correct balance. And then also, if the bank made any errors, if the bank didn't put a deposit in that you know you made, or if a number got transposed and you made a $150 deposit, but they processed a $105 deposit. You know, things like that do happen where, you know, numbers get typed in wrong, or things get posted to the wrong account, or somebody gets a hold of your debit card information, because that happens. You know, they have all those scanners out there, and when you balance your checkbook, you realize that there's these transactions on there that you never did. This helps you to catch all that and make sure that your money is protected, because fraudulent transactions, you have 60 days from the date of the transaction to report it. So if somebody gets a hold of your debit card number and charges a bunch of stuff and you don't catch it in time, if you don't report it within 60 days, then you're out of luck. That money's gone. So balancing your checkbook every month ensures that you would catch it before that 60-day period is over, and, you know, be able to report it and not lose that money. Now, this process that we're going to do right now requires us to jump back and forth between the bank statement. This is a very simplified bank statement, obviously, very short, and the check register. Okay. So let's first look at the check register. Just see how we have this column for check marks, and I talked about this yesterday. In a full-size register, you have this column for check marks. In our little tiny register that I gave you, what we do is these check marks that are already here mean that these showed up on the last statement. Those are already accounted for. Okay. We go through and we say, okay, a deposit of $35. So we find a deposit of $35 and we put a check mark because that shows that it's on a statement. And then I say, okay, a deposit of $100. Here's my deposit of $100. See, there's 2. I want to make sure that I check off the correct one, not the one that was already checked off. And then I have check number 1770 for $158.08. Check number 1770, $158.08. I double check that amount to make sure it processed correctly. It did, so I put a check next to it. And then I have check number 1768 for $46.50. Oops, wrong direction. 1768, 4650. And then 1769 for 7464. 7464. And then finally 1765 for 1950. Now, anything not checked off is outstanding. Okay, so that means it hasn't shown up on the register or the statement yet. So I'm just, you don't have to highlight these, in real life, but I'm just going to highlight them to make it easier for us for the next part. Okay, so here's our parts that have not been checked off. These are the things that have not shown up on the bank statement yet, but have occurred. Okay, so then the next thing we do, oh darn it, sorry, there should always be the starting balance and the ending balance. For balancing the checkbook, we don't need the starting balance. We do need the ending balance. Okay. And like I said, your starting date, your account number should show up on here. See, I think all this got cut off. I'll just say that's the account number. And then the statement dates are 11/01 through 11/30. So if we look here, do you see this 12/1 deposit? We made that the day after the statement period ended, so that wouldn't show up on the statement yet. And then these checks just haven't cleared yet. Maybe they were mailed, or maybe the people that received them, sometimes people that receive checks will hold on to them for a while before they get around to getting to the bank to deposit them. It's kind of annoying because you want to balance your records, but it happens. You just can't forget about this check from October because it could show up down, in December. You just want to be careful of that. Okay, so we'll need our ending balance. So then to reconcile, or to balance, okay, the formula that you do is you take the ending balance, okay, we add outstanding deposits, we subtract outstanding checks. Okay. And we get what's called the revised statement balance. And this needs to equal our check register balance. Okay. So what we need to happen is when we're done with this math, this is the number we need to get, 641.13. Okay. Basically what this is doing is this is what the bank thinks we had the day they printed, but we know that these deposits and these checks hadn't gone through yet, and that changes that amount. And this, by adding the outstanding deposits and subtracting the outstanding checks, we get what would be the correct balance according to the bank. We want it to match this number right here. If it does not match this number, then either we made a mistake or they made a mistake, and we need to do some research to figure out where the mistake is. So our ending balance from our statement is 628.23. Okay, that's our ending balance. And now I need to add my outstanding deposit. Okay, my only deposit that's outstanding is right here, this 125. And then I need to subtract my outstanding check. So I have 1, 2, 3, 4 of those. So I need to add those together. So I have a 50, an 18, a 29, 10, and a 15. Okay, so that's 112.10. So that's what I need to subtract over here. Okay, so I have my ending balance, my outstanding deposits, my outstanding checks. So I'm going to do that math. And my revised statement balance is $641.13. And as you can see, it matches. So this checkbook balances. And so you know that everything is correct because your accounts and their accounts match. This is just if we want to make it simpler for you guys to remember. If you call like the statement ending balance, we'll call it E for ending balance. And then you have outstanding checks. Well, we do outstanding deposits first. So outstanding deposits I'll call D. And outstanding checks I'll call C. So we have ending deposits, checks, and then revised balance would be R. R would be equal to E plus D minus C. So if that's easier for you to remember than the other. So ending plus deposits minus checks. And this we want to equal check register. That's what we want. We want it to equal the check register. So the savings accounts are not meant for like daily banking needs, like paying bills and doing all that stuff. Savings accounts are meant for long-term goal planning. So the money you put in your savings account, you're really not ever supposed to touch. You're supposed to just let it sit there for 10 or 15 or 20 years. CDs are also for long-term. The difference between, and we're going to talk about CDs too, but the difference between a savings account is a CD and a CD is, in a savings account you can actually access the money. In a CD, the money is locked in for a certain length of time, and you can access it, but if you do that, you have to pay giant penalties on it. So they're both types of savings, but one is more flexible than the other. CDs pay a higher rate because of the locked-in aspects, so that the bank knows if you buy a 10-year CD, the bank knows that they should have 10 years to play with this money before they have to give it back to you. So they're meant for long-term goals. So banks, like the Wells Fargo account, you can only have 3 transactions a month. Federally, that's actually a federal law. Federally, there are only allowed to be 3 electronic transfers out of a savings account in a month. Now, depending on the bank, some banks will let you go into the bank and do more transfers or withdrawals than that, but some banks stick to that 3 limit. So that just depends on the bank. Did you have a question, Jason? Okay. And then there are things like maybe necessarily you might have to have a certain minimum balance in order to actually earn the interest. And again, if you do have to have the minimum balance, if the account falls below that minimum balance on any single day in the month, you will not get paid interest for that whole month. So you have to make sure that every single day you're at or above the minimum balance to earn the interest. The interest is money paid to you, and the reason that the bank pays you money is because they use the money that's in your savings account and they lend it to other people. Now, that's your money, they still owe you, so if you go to the bank and ask for the money, they have to give it to you, obviously, and they have money in reserve for that purpose, but the idea is that if enough people have enough money in savings, it allows the banks to do a lot of commerce and a lot of lending. And so they pay you for that right, and that's why you earn interest. Because they earn interest on the loan, and then they pay you a very small chunk of it, very small. Okay, the principal is the amount of money that is used to calculate interest. It is the money that has been deposited into the account. So principal is any money that you put in the account, not money that the bank puts into the account. Simple interest We have two kinds, simple interest and compound interest, and we're going to talk about compound interest later. But simple interest is only paid on money you deposit into the account. Compound interest gets paid on money you deposit and interest that's earned. So compound interest grows faster than simple interest, because simple interest is just paid on money that you yourself put into the account. We didn't talk about, I forgot to talk about the FDIC. I'm going to put that on there. Just on the bottom, write the FDIC on here. The FDIC is the Federal Deposit Insurance Corporation. Okay. You never want to go bank with a bank that does not have FDIC stickers on the doors or somewhere on the bank property. They're federally insured. Now, banks are insured by the FDIC. Credit unions are insured by another, it's not FDIC, but I think it's hold on, let me look it up real quick. Okay, so credit unions are NCUA, and they're insured for $250,000 per person per bank. Okay. So if I have, let's say, $500,000, I do not want to put that whole $500,000 at one account at one bank, because I'm only insured $250,000 at that one bank. But if I take $250,000 and put it in one bank and $250,000 in a different bank, then I'm insured for the whole $500,000. Half of it back. Yeah. So you're only insured up to $250,000 per bank. And that's, if you have 17 accounts at the same bank, it's not $250,000 per account. It's $250,000 total for that bank. So if you become rich and have lots and lots of money, $250,000 maximum at any one bank, so that it's completely insured. Okay. Also, anything in a safety deposit box is not insured. Okay. People like to put things that, like cash or bonds or jewelry or things like that, into safety deposit boxes, and it's very safe, but they're not insured. So if you want to put something into a safety deposit box, you need to buy insurance for it separately, which you can do, just so you know. That's not covered. Okay. The simple interest formula is I equals PRT. I is your interest earned. P is the principal, so the amount of money that you have put into the account. R is the interest rate as a decimal. Okay, and this is really important. If your interest rate is 10%, don't multiply it by 10. You have to turn your percent into a decimal or you get the wrong answer. And then T is time, and it's always in years. So if you're talking about, like, you want to find out how much interest after 7 months, you have to turn 7 months into years. So it would be 7 divided by 12. Okay, so that in years is really important also. Statement savings is the most common type of savings account. Some banks will call this a statement savings, some banks will call this a basic savings, some banks will call this simple savings. It's just your run-of-the-mill standard savings account. Nothing flashy or special about it. Many of them do require a minimum balance, and so this is the lowest amount you can have on any day. that's to earn interest and in a lot of cases avoid fees. A money market account is another kind of savings account. Okay, they pay higher interest, and they usually have a higher minimum balance and initial deposit. And in general, there's more restrictions, and this will vary by the bank. You know, there's not some set, all the money market accounts have, you know, this kind of thing. It depends on the bank. So they're more restrictive. You know, if in a regular savings account you're allowed to do 3 transactions electronically, but you could go to the bank and do however many more you wanted, in the money market account you wouldn't be allowed to do that. Is a certificate of deposit. These are CDs, okay? And a CD pays pretty high interest, but you have a specific amount of money. Okay, so there may be a $500 CD, a $1,000 CD, a $5,000 CD, a $2,000 CD, $1,500. You know, it's a specific amount of money. And it's called being on deposit for a set length of time. Okay, and there are penalties for early withdrawal. Okay, now this set length of time can be anywhere from 1 week to several years. Okay, though you don't really see a lot of 1-week CDs. Like that's just kind of silly. They don't really do it, but they can exist. Most CDs are 1 year, 5 years, 10 years. Okay, and the date that you're allowed to pick it out is the date of maturity. So this is the day the CD is kind of over and money is paid, the interest. Now what a lot of people will do is they'll buy the CD, say $1,000 CD for 5 or 10 years or whatever, and they earn all that interest on it. And then they roll the $1,000 over into a new CD and put the interest into another account or into another CD so that it keeps building. CDs pay significantly higher interest. And this is because the bank knows that you can't touch the money. And a 1-year CD will not pay as much interest as a 10-year CD. So the longer you lock your money in, the more interest they're willing to pay you. So if you have like long-term savings goals, not retirement, I won't recommend retirement for a CD because retirement accounts are in a different tax area and those are kind of separate. But if you are saving for a down payment on a house, if you have kids and you're putting away money for them to go to college, you know, things like that, then CDs can be really good to build your money fastest without the risk of, say, maybe going into the stock market where you risk losing money. So these are really good. If you're looking for really safe ways to build your money faster, CDs are really good for that. And the other thing that would be really good for that would be bonds, like government bonds, which, you know, you buy a bond for $50 and after 10 years they pay you like 75 or something like that. It's all set up ahead of time. And so you know exactly how much money you're earning on it, but it's very safe. Any questions? So we've got somebody, Grace, who wants to put $5,000 into a CD for 2 years, and she's comparing interest. And we have some in decimal form and some in fraction form. So we're going to have to go from fraction to decimal to compare these. So I have that 4.25%, and I want to make that 4 point something percent. So to do that, I do 4 into 1.0, or 1 divided by 4 into the calculator, and you're going to get 4.25. And so that's for first state. And then for E-save, I have 4 3/8%, and so I want to do 3 divided by 8, which I should have memorized, but I don't, is 0.375. And that's for E-save. And we want to write them in ascending order. That means smallest to largest. So I have a 4.25, a 4.22, a 4.375, and a 4.3. 4.22 is the smallest. And then 4.25. And then 4.3. And then 4.375. And so E-save is the best. And that's actually pretty typical, because if we look at these are probably all building-based banks, and E-save is probably an internet-based bank. And the internet-based banks can pay a little higher interest because they don't have overhead. They're not paying for branches everywhere. They'll have like one centralized, I guess they do have some overhead. They have one centralized building where all their tellers work, but their tellers are mostly just customer service phone people. And that one centralized building serves everybody everywhere, because you can't actually go to these banks. So there's Ally is a really well-known one, and there's Barclays, and then there's some other ones, but everything has to be done over the phone or online. His savings account has to have at least $500 or he gets charged a fee. His balance was $716.23, and he withdrew $225, and we want to know what is his new balance. So we had $716.23, and then he took out $225. Which put him, below 500. So now he gets a fee. And that means his new balance is $487.23. Okay, here we have simple interest. Okay, so simple interest. That means we're going to use I equals PRT. Okay. We have 1,200 as our principal. Our rate is 4.5%, but we have to make that a decimal. So let's take a second to just review that. So we'll go here. Decimal percent. Hold on, let me move those down. If we're moving from a percent to a decimal, we're going to move 2 spaces to the left. If we're moving from a decimal to a percent, we'd move 2 spaces to the right. And it's easy to remember because it's alphabetical, so if you put D and P, it goes in that same order. So I want to turn this percent into a decimal, so I'm going to move 2 spaces from the P to the D. And I get 0.045. And then my time is 3 years. So my interest is going to be 1,200 times 0.045 times 3. $162 will be earned. actual question, though, is how much is in the account after 3 years. Our balance is the $1,200 we put in plus the $162 that we earned, or well, that Michael earned. So our balance is $1,362. Okay, this is one of those situations where we have to convert to get the years when we're given months. So our principal is $2,000. Our rate is 5.2%, which is equal to 0.052, and our time is 7 months. But the formula requires time to be in years. Okay, there are 12 months in a year, so we divide the 7 by 12, and that's 7/12 of a year. Okay, so when we do this, the setup is going to be 2,000 times 0.052 times 7/12. And the easiest way to set this up to make it the mathematically the easiest is take 2,000 times 0.052 times 7 and then divide all of that by 12. These are the same thing. So this is just easier to do all your multiplication first, and then whatever answer you get, you divide it by 12. So I have 2,000 times 0.052 times 7, and that gives me 728, and I'm going to divide that by 12, and $60.67. If you're doing months, 7 months, you divide 7 by 12. If it was like weeks, like 18 weeks, you would do 52, because there's 52 weeks in a year. And if it was days, you would do 365. Okay? So whatever number they give you, weeks or months or days, you just divide by how many of that there are in the year. Good? Okay, how much principal must be deposited to earn $1,000 simple interest in 2 years at a rate of 5%? Yeah, okay, yeah. So I have I equals PRT. I don't know P. R is 5%, which is 0.05. T is 2 years, and I is 1,000. So I plug that in this way. And solve for the missing variable. So 1,000 is equal to 0.1. Let me just double check myself. Yeah, 0.1 P. And then I'm going to divide both sides by 0.1. So if I wanted to earn $1,000 in 2 years, I would have to have initially deposited $10,000. We have our rate, we have our balance, so this is our principal, our initial principal, and we have our final balance. We want to know when it'll grow to, so we're looking for time. But we don't know interest yet either, but we can find it. We know that there's $910 in the bank, and we want to know how long it'll take to reach $1,000. So our interest in this case is going to be 1,000 minus 910, which is $90. So we want our I equals PRT, so we need 90, and we have our rate, which is 0.041, our principal, which is 910. We don't know T. So I take 910 times 0.041, and I get 90 is equal to 3731 T. Divide both sides by 3731. And T is 2.4 years. almost 2.5 years to go from 910 to 1,000. Okay, and here we're looking for rate. We don't know rate. Okay, we know time is 5 years. We have principal is 5,000. And we want there to be $6,000 in the account, so our interest is going to be 6,000 minus 5,000, which is 1,000. So 1,000 is equal to 5,000 times R times T. So 1,000 is equal to 25,000 R. Divide both sides by 25,000. And R is 0.04, which is 4%.